Welcome to Building Wealth with Josh Farard, real insights for real families, where we dive into practical tips and expert advice to help hardworking families achieve financial stability and build wealth through home ownership. In each episode, Laura Lee brings you valuable insights straight from Josh Farard, founder of First Nation Financial, with over 30 years experience helping families realize their dreams of financial success. Let's get started.
Welcome back to the podcast where we help you take practical steps toward financial freedom and personal growth. Today, we're tackling a big question. Is buying a home possible with little money down? If you've ever thought, I'll never be able to afford a home because I don't have a 20% down payment, this episode is for you. We're going to break down the myths about home ownership, explore loan options with low down payments, and give you strategies to cover closing costs. Plus, we're going to compare renting versus buying and show you why owning a home might actually be more affordable than you think. So grab your coffee and settle in. For decades, we've been told that buying a home requires a 20% down payment. That's a huge number. If you're looking at a $300,000 home, that's $60,000 up front. And for most people, saving that amount seems impossible. But here's the truth. You don't need 20% down. Many home buyers get approved with as little as 3% down, or even 0 down in some cases. Let's break down these loan options. FHA loans require just 3.5% down, which is great for first-time buyers and those with lower credit scores. Conventional loans, some allow for as little as 3% down if you have good credit and stable income. VA loans, if you're a veteran or active military, you could qualify for 0% down. Down Payment Assistance Program. Many states offer programs to help first-time buyers cover their down payment. So if you've been putting off home ownership because you thought you needed 20% down, think again. There are options out there to help you get into a home sooner than you think. Covering closing costs without draining your savings. Even if you qualify for a low down payment loan, you might still wonder, what about closing costs? Those can range from 2 to 5% of a home's price. For a $300,000 home, that's anywhere from $6,000 to $15,000. But don't worry, there are still ways to reduce or eliminate this cost. First, seller concessions. In some cases, the seller can cover part or all of your closing costs. You offer a little more of the purchase price in exchange for the seller covering closing fees. 2, lender credits. Some lenders will cover your closing costs in exchange for a slightly higher interest rate. And 3rd, gift funds. Many loan programs allow family members to gift you funds to cover closing costs or down payments. By using these strategies, you can dramatically reduce the amount of money you need upfront to buy a home. Strengthening your mortgage application. Even with a low down payment, you still need to qualify for a mortgage. Here are 2 key factors that lenders look at and how you can improve them. 1. Credit score matters. A score of 740 plus will help you get the lower interest rate. A score of 620 may still qualify you, but with higher interest rates and mortgage insurance. To improve your score, pay down credit cards, avoid new debt, and make all payments on time. 2. Debt to income ratio. Lenders prefer a DTI below 43%. Some allow up to 50%. To lower your DTI, pay off small debts and avoid taking on new loans before applying for a mortgage. Taking steps to strengthen your financial profile will improve your chances of getting the best mortgage terms possible. One of the biggest myths stopping renters from buying a home is the belief they can't afford a mortgage. However, in many cases, mortgage payments are actually lower than rent. For example, in Houston, a typical renter might pay $2,500 per month, while a homeowner with 3% down payment could have a monthly mortgage payment, including taxes and insurance, of around $2,100. The upfront costs differ as well. Renters typically pay a security deposit of about $2,500, while homeowners need a down payment of approximately $9,000. The key advantages of home ownership is equity. While renters gain no financial return for their monthly payments, homeowners build equity, often around $5,000 per year, helping them grow wealth over time. Here's why buying just makes sense. Your mortgage stays fixed while rent increases every year. You build equity with each payment, unlike renting. Homeowners get tax benefits, including deductions for mortgage interest and property taxes. For many people, home ownership is actually the cheaper option long term. So, is buying a home possible with little money down? Absolutely. The key is understanding your options and taking advantages of available resources. You don't need 20% down. You can reduce closing costs through seller concessions, lender credits, and gift funds. Strengthening your credit and lowering your debt will make mortgage approval easier. In many cases, your mortgage payment could be lower than your rent. At First Nation Financial, we specialize in helping first-time homebuyers, self-employed individuals, and hardworking professionals navigate the mortgage process. If you're ready to explore our home ownership options, visit fnfloan.com to get started. Have questions? Let's keep this conversation going. Follow us on social media and send us your home buying questions. We would love to help. Thanks for tuning in, and don't forget to subscribe and share this episode with someone who needs to hear it. Until next time, keep taking steps towards your financial future.
Thanks for listening to Building Wealth with Josh Farard, real insights for real families. We hope today's insights bring you closer to your financial goals. And if you're ready to take the next step toward financial security, reach out to Josh and his team at First Nation Financial. You can visit the website at fnfloan.com or call 832-955-9255 to learn more. Don't forget to subscribe for more episodes, and we'll see you in the next episode.